Friday on NBC. Jimmy Fallon and Bozoma St. John host the incredible new competition show.
I hired 10 creatives from all walks of life. They will be battling it out to see who can impress the world's biggest brands.
This is a huge opportunity.
This is the battle for the next big idea.
This is not play.
We're spending millions of dollars.
I'm so excited to embark on this adventure with all of you.
May the best idea win!
On Brand with Jimmy Fallon, Friday on NBC.
Reality radio for a really great future. We're talking real money.
It's too late for us, for humans. Trust me, it's over. You just don't know it yet.
Something happened in the break?
Well, no, it just keeps happening. No.
Oh, okay.
It's this AI thing. AI is trust me.
Are they at your door? They haven't showed up at my place yet.
No. They're making plans quietly in the background.
I'm going to drown them in my lake then. Sorry.
Yeah, that's the problem. They're undrownable. Try to wrap your hands around the neck of one. You can't actually do it. It won't work.
Plus, I don't want to get near the water now. It's cold.
Because AI's entering so many things, and it's really going to make a big. We're going to do a show on this someday, or I'm going to do one or something on really the changes that are going to come to investment advice that a lot of investment advisors are not going to like. Clients might. I don't know. I don't know how good it can be. But Vanguard, we like Vanguard generally.
I love their funds.
We don't like them as much as we used to.
No, because they're conflicted. I also am not a huge fan of their personal advisor program. It's not horrible. It's not great. That's all.
Yeah, it's neither good nor bad. It's just there, and it's reasonable, and at least it's some guidance. But True. Vanguard is working something new into their web presence, into their, the way we all interact with everything now. By the way, just as an aside, I host our website through a company called Squarespace, which is very, very good, or was very, very good. Used to have great customer service. I mean, incredible. I could call a phone number and speak to a human and usually get them within a couple of minutes. It was amazing.
And now?
Now, I'm lucky if I can have a real-time chat with them. And most tech support is through email, which is easily ignored and can take a very long time. So, anyway, we're doing everything.
You sound old, Boomer. Sorry.
I am. But now we do everything online. And so,
I know.
As part of that, to try to help old people like me, they are building in some artificial intelligence, what they call nudges, into their web experience.
For those who won't budge, they're going to help you with a nudge. Yeah.
I knew.
Thank you. I spent all weekend working on that one.
A joke or a pun in there. I think he also has what he thinks is a joke in there somewhere.
I'm not even going to go there because you so beat me down with it that I've let it go. This is a fascinating situation because what they're trying to help people that probably, when I read these things, probably need an advisor.
Yeah.
Probably do, but think, no, I can save a lot of money and do this on my own. Because a stat still astounds me that a third of the money that moves from a 401k to an IRA is still sitting in cash for 7 years. It suggests people either don't know what to do, they're scared to do it, like caller last hour.
I was going to say, or like Wes's wife last hour.
Right, I'm not going to do it. No way, the market goes down.
Yep, it goes down.
It's way high. Exactly. Which is all well, I guess when I read this, their intent is to help people get moving, get something done. Fine. Okay. They say they're going to have about a dozen nudges in place by the end of the year. It sounds funny. Self-directed means you don't have to go along. It also means you're never sorry. No, I'm sorry. That's bad. But the thing is about this, here's the question.
It's another one I don't get. I don't know
why
I don't
means
get
you
it.
never have to say you're sorry or something.
Self-directed means never having to say you're sorry.
Exactly, because it's your fault. Okay. So they're doing all these things. It's great. And by the way, one of the things that was nice to read, because we used to hear a lot from people about all the complaints about their online stuff that was horrible. They say those complaints have gone way down. That's terrific.
Good. That's good.
But here's the struggle that I have. Yeah. And you already mentioned this when we talked about this yesterday.
Yeah.
What are they going to nudge you into?
Well, and that's the part. They're also setting up not just nudges to get invested, but they're saying they have too many funds, so they don't want to show you the list of all the funds.
No.
They want to
We'll
show
tell you
you
the
a
ones.
list that has been condensed somehow based on some sort of rules, but what are those rules? The devil in this case is really in the details.
Big time.
Is their nudge going to be toward a more lucrative, actively managed Vanguard fund?
Which on average probably has an expense ratio of what, 30 basis?
Yeah.
Pardon me, 0.30?
Wait, 30 bips? 30
Oh,
bips?
God. Now we'll never
I had to get the bips in.
Versus an index fund, what they operate at sometimes at 0.03. Yeah, 1/10 of the price. What would you do?
1/100ths of 1%.
What would you
Boy,
do
do we
if
have
you're
to say
running the
that
place?
a lot of ways, don't we?
What would you do if you were running the place? And your job depended on the place being profitable? I don't know.
Wait a minute. Me running the place? Or because I would just, if they didn't like it, I would say,
if you were the CEO and they said, "Hey, next quarter, we're in the fourth quarter now, you got to chick things up."
That's why I could never be the CEO of a company, because I wouldn't.
So that's a question, but it's even worse.
That bad.
Speaking of nudging, I mean, you saw in this article that Robinhood, it's going to enable its AI to help investors build and design custom indicators, which they can use to identify trading opportunities. That's a real form of help there.
That's kind of
help.
like Robinhood nudging you
exactly.
with an arrow in a bow.
You get the idea. Yeah. Again, as you said, the devil's in the detail. There isn't one right, there isn't one wrong. You're going to have to pay attention. You can't just say, sure, I'll go ahead and do that, because they may put you in an actively managed fund that's far more expensive than another one you could have been in.
And the moral of the story is, AI's coming. Hopefully it'll be right. 855-935-TALK.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com, or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
I think I'm going to have to look at something a little more expensive for my Italian villa.
What was wrong with the other place?
I was just reading the description, and, the house...
A little broken down?
The stone house part of it, the original part, was built in 1790.
Yeah, I hope they've been taking good care of it.
And still has its original floor. From 1790. And, by the way, it was built in 1790. What is it missing? What room didn't you have in 1790?
Wow.
In a house? You could
living room?
No, you had those. You lived in the house. You had a bedroom. You had a kitchen.
Yeah,
what was
bathroom?
The one room you didn't have in a house in 1790?
Yeah, okay.
Doesn't have one.
By the way,
those.
I
want one of those. That's a prerequisite.
When I went to Italy in 1981 with my old man who had been there in 1944, the barracks that they had built in still there. Nothing. We walked up and he goes, looks like it did 40 years, hadn't torn it down or nothing. Wow, still sitting right. That's crazy. Yeah.
All right. 855-935-TALK is our phone number.
Don't rent that either,
855-935-8255. And we get questions in at TalkingRealMoney.com, too, and a lot more of the spoken ones.
Hey, Don, I had more of a behavioral question for you, hoping you could help. I'm one of the people that bought at pre-COVID house pricing and refinanced at COVID interest rates. So now I'm, my mortgage payment is very low, and it's, at 2.19%. And me and my wife are in our starter home that we were planning to stay in for 5 to 7 years. And it's already been 8 years, and, we're not even actively looking for for the new house, and we're kind of thinking we're ready to start looking, but we are wondering how much house we can buy. We have a very strong income. I bring in about 800,000. She brings in about 70. We have very small student loan payments. We really live within our means and don't spend very much money. But we're worrying that we're missing out on life a little bit too, by being in this, smaller house and, holding back on some of the fun that we could be having in life. So I'm kind of looking at what I could maybe afford for a house. I know White Coat Investor, someone else I listen to, says your mortgage shouldn't be twice of your gross income. When I look at my current house payment being $1,700 a month, and then I look at what that payment would be, it's obviously a big amount more, but at the same time, we do have that really strong income. We do all the right things as far as maxing out all of our retirement accounts. And right now, with all the extra money, we're throwing it into our taxable brokerage account, which is now our largest one. And I just think that we are not balancing life very well as far as spending versus saving. The White Coat guy said something on a recent podcast that there's no point in being the richest doctor in the graveyard, and that kind of hit home. So I was just wondering if you guys have any recommendations for how much house you can afford, and if you just had any other comments on that topic. Thanks.
Something he said 800,000. Sorry, he said 800K a year in income, right?
Yeah.
I hear that right? Okay. Yeah.
That's what he said. Okay, wow. but here's, I'm going to go back to something that struck me, just right off the bat. When he said, we want to live life more, but they need a bigger house to do it. What is the house part of life that they're missing, I was wondering?
Yeah, that's an unusual. Well, if you're cramped and you're uncomfortable, then I guess you want a lot more space. Yeah, because you and I don't face that.
I mean, the typical rule of thumb is 28%.
I was going to say a third.
28% is the rule of 25 to 30% of your gross income for PITI, payment, interest, tax, and insurance.
Which means he could buy something else, keep the other one if he wanted, because not even spending that. Yeah, here's the thing. We've talked about this. You're stuck in that home because you don't want to sell it with a low interest rate. It sounds like to me too, right? That you remember you got the very 2%er, and now you're going to pay something in the 6s. Mm-hmm. Well, my take is get over it. You have the income to pay the additional interest. If it's a lifestyle situation, go ahead and take the jump. And remember, you can always refinance that if rates go down. Yeah, can't guarantee that, but
yeah.
Other than that, no. I see again, and pay off those student loans too. Why
are you sitting there saving money and paying on student loans unless there's zero rate student loans? There were some of those. Okay. There were some of those. Yeah. You don't pay off anything that's below 4% right now in this environment.
I'd say 5, but okay, sure.
Definitely below 4.
Yeah.
And again, I would buy something if you really want to for your lifestyle. But what is it that you want to do that makes you feel like you're living life? Is it the house or is it other things? Then you go with the cheap house and you go and spend money on other stuff.
Tom and Don are talking real money.
Are you getting ghosted by your prospects? It's time to smarten up your outreach with Text Us. Our powerful SMS platform helps your marketing and sales teams reach prospects more effectively, ensuring your message is actually read. Experience response rates up to 10 times higher than traditional email campaigns and sequences. And stop getting ghosted by high-probability opportunities. Visit textus.com and see how SMS speaks for itself.
Reality radio for a really great future. We're talking real money.
We gather together every Saturday around the radio or the streaming service, the microphone, the headphones.
How do we get to Italy? How are they listening there?
Streaming service.
Okay, wow. It goes with that transcontinental cable that goes under the water or something, or how's that work?
Probably, yes. They're big fiber optic ones now that carry data. Like for example, our web hosting service is in Europe for Talking Real Money.
Wow.
It's in Europe, and those shows fly back and forth. It's magical.
Crazy.
The internet is magical.
Crazy.
855-935-TALK, though, is the number that allows you to enter into the realm here and have a little conversation with us on Saturdays from noon to 2 Pacific Time, 3 to 5 Eastern, on our show on Northwest News Radio in the Puget Sound area. So give us a call, 855-935-8255, just like Jim in Bellevue did. Hi, Jim. Welcome to the show.
Hi, how you doing?
Good.
Good.
What's up?
Good. Hey, I just had a question about, I have about a $10,000 investment in QQQI, and I know nothing's for free, and it sounds too good to be true. It pays 14% almost dividend, which are, I think they're treated in the, as far as taxes go, very well. They're like 1256 capital gains, and a lot of it's return on equity. So it's a very nice tax treatment. And I wanted to, but they don't have a very good long track record. But I wanted to get your thoughts if you know anything about it.
Well, we know of it. It's
the
Morningstar or the Nasdaq
high
100
income,
high income.
Mm-hmm.
So what they're doing is they're distributing gains to boost the income yield. But I fear personally the volatility of this darn thing. As you said, it doesn't have much of a history. It's only been around.
What's the standard deviation?
It's been around for like 1.5 years.
3 years or something?
No,
yeah, it's only 1.5.
Yeah, it's about less than 2.
Tiny little thing, $5 billion expense ratio.
And the problem is we don't even know the standard
0.68.
deviation yet because it takes a few years to measure that. No, it takes more time than we have to measure that. And the portfolio is very, very focused. It is, it's the top 10 holdings are NVIDIA, Apple, Microsoft, Broadcom, Amazon, Meta, Tesla, Alphabet, Netflix. I mean, it's just
sound familiar?
Focused as all get out.
This, by the way, let's just stop right there just for a moment because I had a conversation with a couple this morning about that situation. We would prefer massive diversification over focus. In their case, by being in a few funds, they are very focused. I figured out about 30% of their portfolios in 10 stocks. We don't want to do that because that's too much risk. Go ahead.
I think that QQQI makes the dividend by trading options, is my understanding, and it follows if you.
Yeah, but that you can lose because you can lose your securities if you don't move options right.
Yeah,
and that's why you're getting a capital gains tax treatment from the option trading.
Yeah.
Otherwise,
sounds
it would be pure income.
Me.
It would be pure. It reeks of gimmickry. But there's no way to tell. There's no way to look backward and tell you how this might
can't do that. No,
going
not in that case.
Forward. Other than to say it must, given its nature, have very high volatility. It must eventually have very high volatility. It is a very focused portfolio. It is massively large cap growth. And it really shouldn't be considered as at least as a stable income generator.
Yeah.
I think that's a highly risky income.
You say that it's very volatile, but at the moment it seems to follow QQQ very closely, but a little bit less. If QQQ is up X amount, it's a little bit less, and if it's down,
those options
X
could blow
amount,
up though.
it's a little bit more. Yeah, that's true. That's what I was.
So I mean,
it's
1 year return is impressive, but the only reason it's impressive is because that that segment of the economy has done very well. Going forward, though, we would never suggest this to anyone ever, because one, it's too focused. Two, it's way too focused. Yeah. It's just I'd rather own the whole market than own a chunk of the triple Qs or the triple Qs with an option component, because in the future, the market may not work the way it has worked for it now.
Do you remember March 2000? This is what it feels like with technology to me. It's just gone because it's gone so parabolic.
Well, no, it's not just that. It's also the option writing strategy.
That aside, that sector of the market has been so good that you just wonder. And I'm not saying it's going to happen, but it just has that feel to me. That's why I'd rather be diversified and be in things that are not as exciting, international small cap value, emerging markets, which are also having a great year, but they're not a gimmick. Those are investments in companies and countries and actual economies, not somebody trading options. That I don't like.
So even having that in your portfolio as part of your diversification, we would find that
we would not own it. We would not own it because we believe in generating income as needed from a combination of the actual income stream, the predictable income stream. You see, this is not a predictable income stream. It's just in lieu of the growth. As a matter of fact, this could be a worse deal than the triple Q, because the triple Q is almost all going to be capital gains, pure long-term capital gains. Could be. So it's not something we'd favor. No, sir. Thanks so much for the call. We've got to run. That's what that music means. It means get the heck out of the way. There's probably some news and stuff coming, or traffic or something. Oh, this time it'll be spots and traffic. 855-935-TALK is our phone number. The lines are open for you.
Tom and Don are talking real money.
Hey, business owners, we know you know the importance of maximizing every dollar. With the Delta Sky Miles Reserve Business American Express card, you can make your expenses work just as hard as you. From afternoon coffee runs to stocking office supplies and even team dinners, you can earn miles on all your business expenses. Plus, you can earn 125,000 bonus miles for a limited time through October 29th. The Delta Sky Miles Reserve Business Card. If you travel, you know. Minimum spending requirements and terms apply. Offer ends October 29th, 2025.
Your guides to a really great financial future. Tom and Don are talking real money.
I want to simplify this whole because we get this call a lot about covered call writing funds of various types. QQQI is just another covered call writing fund, basically. They own the QQQ, the NASDAQ 100, which is heavily tech-oriented. Then they sell other folks the right to buy those stocks at a slightly higher price, and they get a premium for that. Sometimes that works really well. But you give up some things with, and by the way, there have been some big disasters. In the early 2000s, covered call writing strategies fell apart because the markets were soaring and the covered call writing wasn't keeping up with it. 2008, covered call writing strategies lost almost as much as just buying the stocks. But you lose in a good market, you lose a piece of the upside, and that's obvious from the year-to-date return of the QQQ versus the QQQI. It's about 3 percentage points difference, about 17 on the QQQ and about 14 on the QQQI. So you're giving up upside. What are you getting in return? You're getting a check, but we don't think that's the way to get a check. That's the only...
I guess... My question always is things, why?
Well, because it feels like you're actually getting income, a check from it, a paycheck. It feels more like a paycheck than taking a combination of capital gains and income, which is what we believe you should do.
What we suggest, You build the portfolio, things, you get the income, plus the market goes up, you take some of that, you get your income off it. It's more sustainable.
Let's say you own the QQQ and you own some bonds. Well, you can take the income from your bonds, and if you need more, you can take some of the 17% in 1 year gains from the QQQ as opposed to the 14 income and gains combination. Make sense?
Sounds complicated to me.
It is complicated. Covered call writing, actually all option strategies add a layer of complexity and by the way, I didn't even get into the downsides of options when you get into counterparty risk. And the pricing mismatches, the valuation problems that occasionally creep into the market because it's a trader's market. And sometimes the counterparties don't honor contract. All kinds of horrible things have happened.
I was at a few counterparties in the 70s and 80s. I don't think I want to go back there. I think that didn't turn out well. So
he waited all show to sneak a joke in.
No, there's a couple puns earlier.
No, they
if you
weren't.
listen
I
carefully.
don't think so. Were those puns? Did I miss those?
Well, we did.
If you'd like to talk with us live, call us on Saturdays at 855-935-TALK between noon and 2 Pacific, 3 to 5 Eastern, like now. This is now, unless you're listening
This
to the
time
podcast.
to do it,
If
actually.
you're listening on Wednesday, it's not now. If you're listening on Saturday, it is now.
Yeah.
There.
This
Does
is
that
the
work?
moment. That moment.
Otherwise, go to talkingrealmoney.com and you can speak your questions or you can type them. Tom likes the typed ones. I don't know why.
Yeah, I like paper. There are a lot of trees around here. Shauna writes us from Muskegon, Michigan. Tom and Don, and maybe Roxy. Hello. First, you're amazing. I've listened to every episode for years. Even when you repeat yourselves, I see it as positive reinforcement because emotions still cloud our financial choices. See, that's something I said to you many times. You said, we already talked about that.
I know, but we still talk about some of these things way too often.
So thank you.
1,737 episodes as of Friday.
That's so shocking. And no, I never tire of Tom's jokes or Don's leaf blower rants. I think those are leaf blower rants are mine, but I'll allow that.
No. I had more leaf blower because remember
did you?
they
Okay.
were always during the show outside until I built my quieter studio. We used to have them all the time.
I just don't like leaf blowers. I think that again that'd be the first thing I outlawed as president. My question, this comes from Shauna, is about 529 plans. It sounds simple. Sign kids up, put money in, but on the Utah My 529 site, there are many choices. It's overwhelming. Then she launches into all the people she wants to help, which is wonderful, and how somebody got into University of Puget Sound, and they're trying to pay for that, et cetera, et cetera. But the important part is, which plan do you take at Utah? In other words, which portfolio design do you employ? Because I always forget there's a lot of, there's static or target date funds. There's create custom age portfolio, custom static, et cetera, et cetera. She goes through all the choices. There's a lot here. And she doesn't even mention the one that I think is best. That's the age-based.
The age-based. That was going to be what I was going to suggest.
I've used that for years.
Yeah, it's super, super simple. Just ignore. Yep. Again, we've mentioned this in the last hour, the last show. Eliminate options. That's the key. Get rid of most of
options trading.
Get rid of most of the complex choices and just focus on what seems to make the most sense, which is, and when you're sending a kid to college, it's got to be a glide path thing because as they get closer to college, you really can't take the risk you could take when they were 2 years old.
Exactly. So the whole point is when they are 2 years old, or I have a new granddaughter who's like 5 months old, I bet her 529 is 100% in stocks. I haven't even looked. I should
darn
look at
close.
That.
It should be darn close.
Yeah.
Yeah.
And then on the other hand, I have a daughter who will be going to college next year. Talk about sad. Hers, I bet you, is about 50-50, half in stocks, half in bonds, because you're going to need some of that money to pay. And by the way, I'll be holding back $35,000 of that for her Roth IRA contributions over the next 7 years.
Awesome. The Roth
I know,
IRA,
it's really
great.
great start.
Yeah.
Great start. So, yeah, I think the age-based is inexpensive. It's simple. You don't have to do it. I do nothing. I check the balances when I either make a contribution or every 6 months I put it in my spreadsheet. But other than that, I don't do it. There's no work to be done. It's very, very simple. So I love it. Age-based.
All right, there we go.
Yeah.
Now, we also take questions and comments that you speak when you go to talkingrealmoney.com on the contact form like this.
Hey, Tom and Don. I was listening to the show the other week, and Tom had an interesting caller from a gentleman who had set up some very generous Roth IRAs for his kids, who I believe he was funding through companies he had where he was paying his children to work for them.
And I'm going to stop you right there because I didn't realize we were coming up on the break. So we're going to continue that after this brief interruption for commercials and traffic. Don't go away, though. Stay.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
And we now return to our caller who was commenting on a previous call he listened to on a earlier show.
I had noticed Tom's hesitation when the guy was describing his scenario, as it didn't sound plausible. And although you certainly can set up Roth IRAs for your children and pay them through your business, you certainly can't pay them way more than the job would deserve. I would wonder if this guy was paying his children $50 to $100 an hour for shuffling papers around the office or sweeping the floors. He even mentioned something about mowing the lawns. So just for all the listeners out there, this can be done, but you have to do it properly and pay your kids a wage that is commensurate with the work that they're doing. Thanks for all you guys do. Appreciate the show.
I don't recommend that for the following reason, because I worry that somewhere down the road, somebody says, well, wait a minute, how come you have a blah, blah number in your Roth? And they might say, show us the documentation. We've always because our daughters worked for my wife's business.
Yeah.
On an hourly rate. So we've always very carefully documented that.
I remember the call. It was
I do too.
It was like 80,000 in his kids' Roths or something, and they were still teenagers.
I know.
And we were going, that's a lot of money.
Because I think somebody, when they have 500,000, the government's going to say, show me where you made that money to put the money in when you were 12. It maybe never happens, and maybe that's paranoid. I would prefer to only use W-2 income to make Roth contributions.
Yeah.
It's been discussed otherwise.
But you could do W-2 income, and you've got...
Oh, yeah, sure.
It comes down room to... there. Yeah, but what he's saying is you don't want to pay your kids $100 an hour.
Sure.
But here's the other thing. Who's going to check?
That's what I'm saying. It may be...
I mean, literally.
Doesn't matter.
Anymore, who's going to check?
Anybody still left there? And if we get the shutdown, what does that mean?
I know. I mean, I'm thinking, I haven't filed my tax return yet. Are they even going to process the darn thing if there's a shutdown?
Yeah, I sent you a note yesterday about that. You saw the good news, right? About our
I didn't understand.
Oh, I thought I forwarded it to you.
I didn't understand the form. Did you understand the thing?
No, I have no idea.
Well, then what was the good news? You didn't understand it either.
Oh, the good news is we don't have to file returns in all these various states.
That thing on our K1s.
Yeah, K1. So it's very confusing. So you're right. Maybe it doesn't matter. No, I owe nothing. Here you go. Here's my return. Any questions?
I owe nothing.
Give me a call.
That one. If you owed something last year and then you say nothing this, I don't know.
I'm kidding, by the way. I do not mess around on my taxes.
No,
I have somebody else do the taxes, and I pay them.
No.
I don't mess around. It's one area of my life. No, not going to happen.
I do my own taxes, but
I know you do. You're way braver than I am.
I have a computer that does it.
I have a computer that could do it too, but there's no way I'm doing it. So, That when the returns are 120 pages. Forget it.
No kidding. It's
just ridiculous.
Such a task. Particularly
you're right. Does anybody read the 120? Probably AI read the 120 pages and go, wait, section 47 who knows?
Well, actually, I ran our K1 through chat.
Oh, yeah, you told me that,
It totally got confused by it. It really did. It got confused. Went, no, wait, this makes no sense. So I'm going, if it makes no sense to you and your artificial intelligence,
how am I going to figure it out?
I got analog intelligence. It doesn't work. It doesn't work that well.
With a much slower synapse.
Slower. Hey, if you want to ask us questions in the future, now that the show is ending, go to TalkingRealMoney.com. That is our website. There you will find a button that says Contact Us. Send us in a question. If you want a bunch of help, Tom, how do they get it? Quickly, you have 10 seconds. 5.
You can go there and ask an advisor.
Never mind. Ask an advisor.
Okay, I thought I had that right. Sorry.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.